The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. It's Bobby Rains here again for our once every 3 weeks Investors Observer members only workshop. Yeah, as always, most of the time here is reserved for questions from the audience. So if you in the audience have questions, put them in the question box and we will get to them either at the end or as I'm talking. Just sort of, I have the questions, they show up in front of me. So it's relevant to what I'm on right now. I don't have a problem with being interrupted, but if it's a question for the end, go ahead and put it in now and I'll get to it at the end. That's fine too. All right, so let's look at our agenda. We're going to do, as usual, a little bit of a market update. Somebody stole my R. I don't have a big update for Investors Observer. We're working on some stuff that's pretty cool, but I'm not quite ready to update you on it yet. And then, yeah, the rest is member-driven content, questions, site demonstrations, anything that those of you who are hearing me talk right now are interested in. That's what the rest of this workshop is for. As always, if you think of a question between workshops, don't hesitate to send it to us. If it's a thing that needs to be answered today, we can answer it today. If it's a thing you'd like to see me expound upon in the webinar, maybe put some slides together, something like that, just mark it for the workshop and we can do that. All right, so with that, let's get into the market update. So this chart is 2 years and each candle is a week. I kind of pulled this chart, at least in part, just to highlight sort of how ugly the fourth quarter and December really were, because they were both pretty ugly. And then also I wanted to highlight being back above the 2600 level here on the S&P 500, which was the sort of first and most significant resistance level on the way back up. There are more as we get back, as we keep climbing. But that was sort of the first one, and we blew through it, all things considered, relatively easily, which is kind of a good sign. This chart gets a little bit more complex. We're also back above the 50-day moving average, which is that blue line there. The pullback yesterday and the sort of weakness today are not totally unexpected. There's something like 10 or 11, I think it was, green candles in a row here. Candlestick theory usually tells you should not see more than about 7 or 8 of the same color in a row. So it's not altogether surprising to see some weakness after that big run up. But yeah, there are lots of points between here and new highs that can and probably will to some degree serve as resistance, including the 200-day moving average, which is now right at 2740. Hopefully, if we keep going up here, the moving average will sort of turn and start to move back up as well. Typically, you prefer to hit a moving average that's going in the same direction as the index as opposed to in the opposite direction. And then our third chart today is a comparison of the NASDAQ 100. That's the biggest 100 companies that are listed on the NASDAQ, and the S&P 500. You can see here the S&P is down about 6% over the last 6 months, whereas the NASDAQ 100 is down almost 10. And the reason I did this is the NASDAQ 100 is kind of a proxy for momentum. So a lot of the things that were the leaders in the rally from 2016, 2017 are still lagging. They have been, some of them have been pretty strong in recovery. But some of them, like yesterday, the NASDAQ 100 was down more than any of the other major indices. So they're still getting hit pretty hard on signs of weakness. So that's still a little bit, we'd like to see some leadership. It doesn't have to be the same companies. We'd like to see some sort of, leadership emerge in the market, and it's not coming from the NASDAQ 100 right now. What else? Yeah, let's get to that. All right, so we still have a lot of these are the same that they have been the last few, or at least the high points. On trade, someone has to make a deal at some point. More China tariffs are supposed to kick in on March 1. There's no law behind that. It's essentially a national security declaration by the president, so he can change that pretty much whenever he feels like it. He already moved it from December 1 to March 1 to give negotiations time to happen. But as I noted here, the rhetoric between China and the U.S. seems to be getting hotter as opposed to easing in the last week or so. So that's not necessarily a good sign. I think that probably helps contribute to some of the weakness we've seen the last couple of days also. The EU also threatened tariffs today. If Trump goes ahead with auto tariffs, that would again also be bad for stocks. And then the government shutdown hasn't really affected the economy yet. There's lots and lots of personal effect. And then, outside of government workers, businesses with exposure to areas with high federal employment are also likely hit pretty hard as well. I wouldn't want to be a cabbie or an Uber driver, or honestly, probably a waiter in like Washington, D.C. or Northern Virginia right now. And then, there's a lot of missing data. The Commerce Department puts out a lot of data, on a rolling basis. But there's a lot of missing data that make investment decisions hard, both for us as investors and also for business owners. So it's hard to know where to deploy your resources if you're not sure exactly what's going on out there in the economy. The Fed is actually probably the least exciting at this point. I think everybody expects a pause. Anybody who works at the Federal Reserve has pretty much said as much since the last meeting. But also, I would kind of expect a lot more noise as we go forward here. Starting January 30, that's the next press conference. Every meeting will end with a press conference. And the press conferences seem to be where Jay Powell struggles. The written statements, the market seems to know how to interpret. But when he starts answering questions live in front of an audience, seems to be where he says those things that the market doesn't care for so much. So that will be kind of an interesting thing to watch in terms of whether or not the market and Powell can kind of figure each other out, or if we keep having these sort of freakouts over things that Powell says that he then ends up walking back. And then politics in Europe. Brexit doesn't seem to be getting closer to a resolution. The deadline is obviously getting closer. That's actually at the end of March. And again, this is another thing like the shutdown, like trade, that make sort of long-term investment decisions hard for the business community, right? I mean, knowing where to put a factory when the trade situation could be drastically different is a really hard decision to make. So my guess is that people are probably either opting to not build in Britain or opting to just punt on making the decision altogether. And so you could see after a resolution some uptick actually in business activity as people are like, oh, well, now we know what the situation is. We can make this decision. But to some degree, some of that economic activity that gets delayed ends up being just sort of lost. So those are the things we're watching. Earnings season also started last week. There hasn't been anything super exciting in terms of a story that moved the entire market. All in all, I would say the reaction to earnings reports has been positive. As we've mentioned in our weekly blog posts a couple of times recently, there was a period where it didn't really matter what your company reported. If there was something that seemed like a positive, the market would react to that. And then there were a few quarters last year where it didn't really matter what your company reported. If there was something the market could interpret as a negative, it would react to that. And we seem to be in a situation now where the market seems to be kind of trying to take what seems like a more reasonable approach to me. Banks sort of went in different directions because their earnings were sort of different. We haven't seen a situation like we had with Caterpillar in the first quarter of last year, where a sort of offhand comment took the Dow down by about 500 points one morning. So that's all seems like a positive in terms of market stability, at least. From our point of view, we're here looking at things, trying to study earnings and trying to find the right spots to put out some new trades. We have been light on trades in most of our products because of the volatility in the fourth quarter, and then a lot of this uncertainty I've been talking about here this afternoon. We'd prefer not to put things out that are going to lose. So we're trying to kind of let discretion be the better part of valor at this point. So yeah, with that, if anybody has any questions, that's all that I came in here ready to say today. And so now it is time for the questions from you. All right, so we have a question from Ron, who says he has a question about his current direction. He's bought deep in the money leaps, so at about 90% intrinsic value, and he's selling calls against them. Is this a reasonable approach? Ron, that's certainly a reasonable approach. What you're describing is a diagonal spread. We don't necessarily buy leaps for our diagonal spreads all the time, but we do at times do that. And so, yeah, if you're right, I mean, the risk there is a super sharp drop in the market. You'll lose obviously a lot of intrinsic value in those options. And then I don't know if you want to call it a risk, but there is some chance if there's a sharp rally, you could have to either deal with assignment on a sold call there, or you'd essentially make less if you let the position be exercised and assigned than you would if it just went up. But yeah, in terms of an outlook, that seems like a relatively conservative to bullish strategy, so that seems fine. All right, so Claudia says, what signals are we waiting for before picking up the portfolio activity again? So it's a couple of things, Claudia. One is, we like the market's direction recently. We're kind of waiting for this pullback, to be honest, because yeah, that number of candles in a row always starts to make us nervous a little bit. And then also, on the individual stock side, we went with Nike a couple weeks ago because we like the name and we like their earnings, which were in December. And it seemed like a good situation. And that's really what we're looking for, is sort of a holistic, good situation, which is just a little bit harder to find now than it was, back in 2017 when everything was just going up all the time every day, and it didn't matter quite so much, the picking quality names piece. So that's really what we're looking for, is that, and we're hoping that that earnings will sort of help us separate some of the sheep from the goats in that regard. All right, so Reggie wants to look at Goldman Sachs and Johnson & Johnson. This is maybe not the best way to get a chart. Let's see. All right, so yeah, Goldman has been beaten up pretty badly. I mean, some of that was the rest of the market. Goldman in particular had a scandal involving something called 1MDB. I think that's the right number of letters, which was essentially they helped some folks in the government of Malaysia sell a bunch of bonds to start a sovereign wealth fund, which is a little bit interesting because most sovereign wealth funds are started with existing money. In any case, it turns out that they helped government officials sell a bunch of bonds to start a sovereign wealth fund, and the government officials pretty much just sort of stole all of the money instead of starting a sovereign wealth fund. And that's certainly not great for Malaysia. But Goldman collected somewhere around $600 million in investment banking fees on that deal. So now Malaysia is saying, hey, Goldman, you should have known something about this here. So we'll kind of see how that works out. Obviously, the market's not as sour on the stock as it used to be. But that is kind of an overhang. I personally don't love jumping into stocks that have any sort of overhang like that. you don't see us get into a lot of pending mergers. We try to stay away from having positions open during earnings even, just because there is a lot of uncertainty there. That said, I'm not sure exactly what the downside is. If you're looking to hold it forever, maybe you could get a cheaper, maybe you could get it cheaper if you wait until this resolves itself. But that kind of assumes that Goldman really gets whacked. The way a lot of these things worked, the way a lot of the bank settlements worked after the financial crisis was the settlements actually sparked a rally because it removed the uncertainty. Right? People had priced in some nebulous bad thing, and then once they could put an actual price, even a price with a lot of zeros on it, things went up because they knew, okay, well, this is what this is going to cost now, so we feel comfortable getting into this. So that's kind of how I feel there about Goldman. And I mean, yeah, from a technical perspective, they're kind of at some resistance here. They had some flat spots here, and they look like they're at some flat spots here. And it's not surprising to see the stock rest after jumping up like this after earnings. But in terms of where it goes from here, I really think it probably has more to do with the overall path of the economy and the resolution of the one MDB scandal. All right, and then we'll look at Johnson & Johnson also. Somewhat similar to Goldman, Johnson & Johnson also has some, let's call it, legal overhangs regarding asbestos in baby powder, I think it was. And so, yeah, that was the cause of some portion of this. I think J&J has earnings this week. Is that right? Yep. They may have been today, actually. Now I think about it, not available frequently means earnings were today, and we haven't gotten the next quarter's earnings date yet. Yeah, so I don't remember that one exactly off the top of my head. But yeah, I mean that certainly explains this big drop. Was the asbestos thing, and then yeah, it's not. It doesn't seem like the market wants to give them all of that back right away. So this is another one where, maybe this is a good price. Okay, yeah, so earnings was yesterday. Yeah, so maybe this is a good price. It doesn't seem like they really rallied much after earnings. So if this is a thing you're holding for a long time, J&J pays a decent dividend. The company probably isn't going anywhere. But yeah, I don't know. I don't think anybody really knows how to price, a giant asbestos lawsuit potentially. The company's disputing the claims. They've had some other cancer claims that they settled over the last year or so. So you could maybe look at one of those to get an idea of what the settlement would be. But yeah, I mean, at that point, you have to then apply that settlement to your discounted cash flow model, which I don't really know how to tell you to do that. So yeah, I mean, it might be a good play. That's the kind of thing that I generally try to stay away from, again, because I don't care for the sort of known uncertainties. I try to get as much uncertainty out of things as possible. So an overhang like that, generally, we would stay away from. But yeah, again, for a long-term play, it's Johnson & Johnson. They're not going anywhere. They pay a decent dividend. It's probably fine from that standpoint, but in the short term, I have no idea. All right, so Reggie says the emails we get for verticals. Reggie, I believe what you're talking about is the investors keyhole trades. You should get 4 of those a day, and those can be found under investors keyhole in your left nav here, and then you can just click into them from there. So McDonald's was the last one we did today, and yeah, it's here. And then if you want something from a previous day, you just hit go back by a page or two. If you're interested, if you think you're not getting emails, you can always check your settings. Just go to settings there, and then yeah, communication preferences. And so depending on your subscription, you'll have different things to choose from here. But Investors Keyhole, you can actually, if there's one you don't like, you can opt to not get it. Push notifications will actually just pop up a little box in the corner of your screen. And then, obviously portfolios, full swing stocks, and then the general emails like morning update, market intelligence center, stocks to watch, things like that. Reggie, that's correct. We don't do straight call and put buying currently. We've talked about adding it to the trade idea generator in some way, but we're not there yet. Some of that is because of our sort of institutional DNA in terms of we provide options research to some Wall Street firms, and they wanted things where there was a little bit more skew toward lower risk than higher reward, and some of it's because they wanted things where you can put a target return on a covered call, where it's very difficult to do that with a bought call. But yeah, it is a thing that we will probably add at some point in the future, but it's not anytime soon. So Ron, I'm not 100% sure I understand exactly what you mean by a system. Personally, I think anybody who's come to more than one or two of these workshops would tell you that we don't. Yeah, I personally am not a believer in a hard rules-based system. Lots of situations are different, and my experience with systems is that trading systems like that is some of them work for a while and then they blow up spectacularly. That tends to be how that works. So we prefer to be sort of adaptive. Take the information as it comes in and make the best decision you can in the moment. Certainly learning from history is helpful there, but I don't believe that there's the market is a solvable problem in the sense that you can come up with a system that just wins and then you're good to go. In terms of your to relate it back to your previous question about selling calls against a long call position. What we do typically is, what we did, our idea with this Nike call here, which obviously we didn't buy a leap, but enter it so that we get a profit if the stock doesn't go anywhere. Nike was at, I don't remember exactly where Nike was when we opened this call, but I think the stock was above the 77.50 strike price here when we opened this position, and so that means that we had some downside protection, but we had to have a profit that we're happy with if the stock goes up. And so that's the kind of thing I would look for. I certainly wouldn't sell a call against another call that would result in a loss if it were to be assigned. But that's typically as far as I would go in terms of having a system, is try to understand what you're doing and be relatively conservative with it in terms of especially selling calls against something else. Because if you sell a call and the stock goes way up, you're either going to get assigned or you're going to have to pay a lot to buy it back, which makes it hard to recover. So yeah, if you're going to sell a call, try to sell a call where it's going to result in a profit or a small and manageable loss, or be ready to be on top of that position and managing it every day in terms of being ready to roll it or buy it back. Well, so Ron, assigned as a profit, if in this case it is because we paid $10.85 and the difference in strike prices here is $12.50. It's possible to construct a position like this where you would pay $15 where the strike width is $12.50, in which case being assigned would not be a profit. So it entirely depends on how you structure the position. All right, so Ron says it appears that bull puts are recommended more than bull calls. I assume, Ron, you're talking about the Investors Keyhole trades, and that's correct. There's a lot of reasons for that. Generally, by and large, people tend to like the credit spreads more than the debit spreads. As somebody who's done a few of both and managed portfolios of both, the credit spreads are a lot easier to manage. Simply because there's no dividend assignment risk. Anytime you have an in-the-money covered call, it's potentially could be assigned early ahead of an ex-dividend date, and so more trades are available to you if you're willing to do the put credit spreads as opposed to the call debit spreads. That's that and actual subscriber preference is generally the reason for that. So yeah, I mentioned this in passing earlier, but we do have a couple of pieces that we write every week. You can find them in the Market Intelligence Center that are good for, there's lots of good stuff on the Market Intelligence Center, but Market Week Ahead is a post that we put up usually Monday afternoons. And we try to give you a little bit of an idea of what's going to drive the action in the market that week. We try to put in an earnings calendar, give you an idea of what's been strong lately, and an economic calendar in there as well. And then the Market Week Ahead, no, Market Week Ahead is the one I'm talking about now. Week in Review comes out Friday afternoons. We try to review what happened in the market, give you some analysis of what's going on, and we try to approach it from sort of the fundamental side, and then we also try to do a pretty deep dive on some technical analysis and get an idea of what's going on with the charts there as well. So if you're interested in sort of what we're thinking about the market between workshops, those are good pieces to look for. Reggie, we have no relationship with the Motley Fool. I think sometimes they buy ad space from us, but that's the only relationship that we would have. Oh, Rick, I'm not 100% sure how to answer that question. So Rick's question is, what is the point of Davos? It seems like an excuse to go skiing and drink hot toddies. And does the average investor care? To be honest, Rick, I don't really think so. It seems like a chance for very rich and very powerful people to get together and congratulate each other about all their success. I can't think of any real instances where anything particularly noteworthy has really ever come out of it. So, it's kind of interesting. I know CNBC has been broadcasting from there, but I don't think there's a lot of market moving news coming out of there in particular. And certainly nothing that anybody with a time horizon past, some pretty short-term trading really would care about. Ron, we don't typically use index options. We will use the index ETF option, so SPY instead of SPX. And typically that's just because you can chop a zero off the amount of capital required to use the SPY instead of SPX, and that's pretty handy for people who are looking to maybe not have quite so much risk, or have smaller accounts in either case. But yeah, SPY is the indexes on the actual SPY, or the options on the actual SPY ETF are probably some of the most liquid options in the world. I would guess probably more than the index options even. I don't look at the index options a ton, but I forget exactly what the number is, but a pretty mind-blowing percentage of total option trading volume is on the SPY ETF. So that's in terms of a good solid liquid option market that tracks the tracks the S&P 500. That's a good place to look also. Rick, I don't have any comment at all about Sam Zell buying gold. It's a thing that people, buying gold is a thing that people do. I certainly recognize its value, I guess, as a hedge against inflation in some cases. I don't know that it's actually done that well over the last 10 years or so. But yeah, I don't have anything particularly good to say about that. I think Warren Buffett has a line about their earnings growth in gold that maybe I would refer you to, but yeah, I don't have anything else to say there. Recordings of past webinars are, I believe, available if you go to Market Intelligence Center and members only workshops. Yes, you can find them here. So our last one was the 2nd of January. This will probably show up here tomorrow. So you can go through here. You can find both the slides and a video, and there will be a link to sign up for the next one, which will be whatever 3 weeks from today is. And there are no Wednesday holidays, so that seems unlikely to be a holiday. So 3 weeks from today will be the next one. There'll be a link to sign up there tomorrow when we put this up, and we'll also send out an email to everybody as well to let you know when that gets posted, and you can go watch it. Reggie, we do have some videos on setting up trades. If you go to our video guide, which is down here on the left, we have some videos for actually like placing trades, placing and managing trades, and then we have other videos about how the strategies work. Some doing analysis, and then some more about our products as well. Rick, I'm not going to rule out trades involving pot stocks, but again, I don't love trading things that are super volatile and unpredictable. And that's the hot thing right now. We didn't trade. Pick one. We tried to stay away from the rare earth metals when they were all going nuts. Was it 10 years ago now? And then since then, there's been, countless things offering new fracking technology, all the cryptocurrencies. Yeah, we tend to try to stay away from the stuff that's kind of just going up because everybody's buying it, because at some point everybody stops buying it and it goes down in a hurry. At some point, it seems like the regulatory environment is moving to a situation where pot stocks may be legitimate profit-making businesses where you can, do real analysis on. But it seems an awful lot like people are buying those stocks hoping that a bunch of other things will happen at some point in the future, and that's not really our thing around here. So Kit, we talked a little bit earlier about the lack of activity in the last month, and it's really about the market. I know we're up, month over month, but we got, we're trying to put things out over earnings, so we've got that going on. There's a lot of a lot of sort of existential things around the market that kind of make us nervous. So, like I said to Claudia earlier, we're kind of looking for the right positions or the right situations to put trades out. We are here and working, and we're trying to get the ball rolling on that again. Because it does seem like there should be some opportunities, and we're looking for that. On a daily basis. All right, I'm getting questions from two Rons here. So one of the Rons said, have we covered portfolio hedging strategies in the past? We have a little bit, not in any great depth. I think somewhere you'll find somewhere we've discussed the idea. Typically, right, like put buying is a decent portfolio hedging strategy. But I think there are some people who would also argue that having a cash position ready to deploy when the market really takes a dive is another hedging strategy. But yeah, I mean, I would typically prefer to say buy an index or an index ETF put, just because the transactional costs are lower there than trying to hedge on a per position basis. But that's the gist of it. I don't have anything off the top of my head to say about portfolio hedging, other than that. All right, so someone bought from the other Ron today. Someone bought 6,000 calls against 89 open interest, and we covered it in the investors keyhole trades. So. Here we go. Yeah, I mean, somebody taking a pretty big, or yeah, it's hard to tell here, and I didn't look at the data. Someone taking a big long call position is typically a bet that a stock will go up, and that's a pretty sizable position. And I can't tell if it's somebody opening it all at once, or a whole bunch of people jumping into that, but that's a month away and $10 out of the money. So we got a lot of leverage to it in terms of the how much the price that option will go up as the stock goes up. It also means that the time decay is going to be pretty high. So that's somebody making a pretty bullish bet. And it's putting a lot of money at risk. So, I mean, typically the reason people are interested in this kind of thing is, a lot of times big things like this are being done by, the so-called smart money, hedge funds, something like that. And so if that's the kind of thing that you're interested in following, we certainly have that there. And, I mean, sometimes they work out and sometimes they don't. Buying relatively short dated out of the money call options is probably the number one way to get busted for insider trading. I see you said that there. I don't think anybody's going to offer to buy McDonald's anytime soon. But yeah, I mean, that is the number one way that people get busted for insider trading is because buying short dated out of the money call options can really make you a lot of money if you're right. And so, this seems like a place where somebody's making a pretty big bet that McDonald's is going to go up pretty significantly between now and February expiration. So Rick asks, do algos affect option trading, or is it more of a concern for stock traders? Rick, I think there is some algorithmic activity in options trading, but where options, I think it's probably more prevalent in future and index option trading than it is in the equity options. But generally, I don't worry about it as much. I mean, a lot of these algorithms are probably just doing sort of basic market maker activity in terms of trying to buy something and sell it relatively quickly and make money off the spread. Typically, what that does is it tends to compress the bid-ask spread, which is good for the good for the average trader who would otherwise be looking at a much wider bid-ask spread. There may be some of it going on there, but it's not a thing I worry about a whole lot. And if there is, it's again probably in things like options on the SPY and the Qs and things like that. But it's not a thing where I think the market is getting manipulated or any of those things that people those things that people really worry about and criticize algorithmic trading for. All right, yeah, if there's more questions, I'll be glad to answer them. Otherwise, we can sign off and we'll be back in 3 weeks, which is somewhere around February the 13th, looks like, will be our next members-only workshop. So again, you can sign up for that on the blog post tomorrow. And then, we'll send out invitations a couple weeks ahead. Rick, Rick, I wish I knew who was going to win the Super Bowl. I don't know. Stylistically, I'd like to see the Rams win, but that's a personal preference more than a prediction. All right, I don't see any more questions coming in, so I'm going to go ahead and sign off. Thank you all for coming, and look for the replay coming out in your email. Thank you.